Hi, this is Randy Finney with Right Side of the Chart, and this is an early session update for Thursday, April 10th, 2025. It is 8:46 a.m. Eastern Time, so I'm starting the video. I just felt like getting one out pre-market. I'll touch on the CPI actually came in lighter than expected. Not a shocker, but to my surprise, I figured we'd come in probably a tick or so higher. And that that could, if again you take this thing on for whatever it's worth, a lot of criticism out there on the CPI, but that's what the number was. Consensus was for a month over month increase of zero point 0.1, came in actual negative zero point 0.1 year over year. Consensus was 2.6, came in at 2.4, and then you can see the X food and energy and year over year and month over month right there. And surprisingly, the market's actually pulling back a little bit pre-market on that. But I'm giving you my thoughts. I also said this in the videos yesterday at the close, and also several times in the comment section. This is where yesterday is where I did reverse at the highs, hit my price target, covered that. My target was hit last night in pre-market, and I'm actually just went. So I covered that short. We had about a 3% or so drop right down. I'll get to that level in a second. And I've added back a little bit of longs. I'm going to keep it very light. I've also increased my grains today. I'm going to get to that in a second here and share a few other trade ideas. So good time for me to, I think it'll be noisy. What I mean, back and forth, some grinds, world of the active trader. But I'll either, kind of refrain, sit on my hands as much as possible, and or also keep things light on the equity markets till the dust settles. Like I said yesterday, meaning big move like that, going to see some volatility. But let's dive into the charts. Let's go there. Let's start out with this is pre-market QQQ. Remember, there was the trading range right there. There was a breakout above the green level. There was the not tweet, whatever you call it, from Trump's new social media platform. I mentioned DJT is a potential buying up yesterday. I told you I bought some of that, and for that reason, it's going to be very hard going forward for a trader or even an investor to not follow that in a volatile market because. With his ego, he moves the market and he knows it. And so, again, he's going to release things on his Truth Social platform. I read the headlines. They said he sent that out at 12:13. And I looked at the futures, the 12:13 candle, there was no movement. So it was 12:14. So I told you I was watching it and I had somebody forward that to me right away. And that's when, so it was plenty of time to get in if you got that news from him. And like I said, I watched the CNBC. They were scrambling to find the source of why the market was starting to move up, and so they must not follow Truth Social. And so whatever, you guys again do what you want. I don't I could care less if you like the guy, don't like the guy. It's the world we live in today. He's going to send those things out and release major things via Truth Social, and that's his dissemination of public information at that point. So. All right, let's. So here's levels, guys. This is the level. If we pull back this morning, that's first support there. Again, these are the same levels I believe you had on the charts for the last several days. The 15-minute charts of QQQ. If I don't make mention, just look up top. You can see what time frame I'm covering here and here. 15-minute chart. Same one I've been sharing. So any pullback to that level is support, as is all the way back to the green line. I'm I don't have strong convictions, hence the reason that, other than I had strong convictions we'd pull back. So that's why I went home short last night. But I think what'll happen today, they're selling in pre-market, and only because the futures are down, they'll probably gobble it up there. And my guess is probably give us one last thrust up, maybe to this uptrend line here, right there. And that's the uptrend line comes in like this. So let me pull it a little tighter, closer to that. Where is it? Come here, trend line. Move over here so I can grab the end of you and pull you down. Yeah, it's about there. So, all right, so that's it. Probably get up there today is my best guess, but I'm not betting anything heavy at this point. There's no reason to lock in some of those monster gains from yesterday and even the last few weeks, as the market will probably go into that noise mode for the remainder of the week. All right, noise meaning just back forth. And, if you can ping pong it off the support and resistance levels, that's still the strategy right now because fundamentals are still very much in question. Like I said, I think the market's going to turn its focus from tariffs over to the economy and Treasury bond yields and all that other stuff now. So, let me give you. Okay, this is the 15-minute chart of NQ. So this is the level I was talking about. That's where I had my, and we're back to it right now. That's where I covered last night. Had a buy to cover limit order. So it was good for about a 3% drop off that rally into resistance yesterday. And we're there now again. So I'm going to pause the video. I'm actually going to add a little bit more. I just added before the video and I'm going to add right now since we're there. Okay. All right. So what I did just add, doubled up on some NQs and so I actually shorted some VIX too. All right, so this is the level to watch right now. Support right there. Again, just kind of driving off gut feel and instinct right now and trading. And if that level breaks, you can see I don't have support till down here, but I'm pretty confident they're going to buy it up here. So I increased to a pretty good position. I think they'll have another run up at and possibly a little bit higher. That's kind of my favorite. We hit really good support on the weekly charts and daily charts. At yesterday's lows, like I highlighted, and so my guess is we'll probably take out the highs we hit yesterday. Again, not going to bet the farm on it. And you can see if we can't hold this level, 18.7, 14.50 right there, where we're at right now as I do the video. If we can break it with conviction and they don't step in and buy, that's going to be your next support level. That would be the next objective long. And I would put even better odds that they'll, or as good odds that they'll buy it there. I'm trying to draw a little trend line here, see if that comes into play. I'm just playing around with the charts as I do this video here. So yeah, maybe they sold it on that, but that's not, whatever. I like this support level. All right, enough on that. NQ, this is a chart I've been giving you, the 120-minute chart. Let me try to, everything seemed to get squeezed out here we go. You can see 6-month 2-hour candles. There's that same downtrend line. You can see it nice and clear right here. So this is kind of what I think we'll get, and that's what I'd like to ride these longs up today, get out again, maybe one more short. And then if we break out there, and then my preferred bounce target zone was already hit once. Possible. We'll see, guys. I wouldn't bet on it right now, but I'm very open to another run up there. And if things get really, market really gets giddy, we never did hit my max bounce target zone, which again was not my preferred. It was just where I could see us going there. That was, like I said, where I preferred to see and preferred to go, back in short for the next leg down. And so, again, those are still the levels they were then and they are now, potential bounce targets. We'll take it day by day, step by step. So I think I drew out pretty explicitly where I think things are going, and then if they don't work out, how to react and all that. There's nice support right there at about 18,380. Should we go much lower? That's that comparable level. The green line I gave you on QQQ, the breakout of the recent trading range there. All right, enough on that. Let's cover some other things. Talk about the small caps for a second. Talk about the smallies here. IWM, this is I toggled over to a 15-minute chart. We just put in yesterday at the lows. It was a divergent low. We know that the NASDAQ had its best day in almost 25 years. Oh, by the way, guys, the headlines, I read it. So the NASDAQ, and I'm going from memory. I don't have it in front of me. Best day they quoted since, I believe, the dot-com bubble. So 25 years ago, whatever it was. S&P 500, the best day since, I think, 2008. And then one other index, the best day since 2020 COVID. Does that sound familiar there? Did any of those dates ring a bell? And this is something I've known forever. This is not new to me. They were all in bear markets. The biggest moves, I've always said this, so don't, because I'm saying this because a lot of folks who are new to this, you're wired as, my God, that's bullish. The NASDAQ went up 12% in a single day. No, on the contrary. The biggest moves in the stock market, typically, and the vast majority, always come in bear markets, not in bull markets. So that just helps to confirm, gave me another check mark that we are in a bear market with most likely more to come. Because again, that just matched the tone. The dot-com bubble burst. That's what the Nasdaq did. The Nasdaq was the king of the, back then in 2020, it was all about the Nasdaq. The Nasdaq composite fell 78% off its dot-com bubble peak, which peaked in March of 2000. From there into the 2002 lows, 78%. The S&P fell, but not nearly that much, because it was all about the bubble in the Nasdaq and everything.com. And the financial crisis, and from the bear market that started in October of 2007, ended in March of 2009 with the S&P 500. It was an unusual bear market because the S&P fell in lockstep about exactly as much as the more higher beta Nasdaq 100. They both fell right around, I am going from memory, it was up 56%. And that's unusual because usually the S&P falls less because it's chock full of steady, heavy, I call them grandma stocks, utilities, dividend paying stocks, REITs, defensive issues. And what happened is the financial crisis in 08, the 07, 09 bear market was all about the banks being over leveraged and a bubble there, a debt bubble, both in the real estate market, which of course translates to the banks. Tech doesn't, that doesn't affect tech. And so in that case, the banks failed and the government bailed them out. They would all been, big banks all bust. The financial system would have gone bust. So what I'm just highlighting, that's why you see back, they said the S&P had its best day since 2008, right? Because that 2008 market was all about the banks and primarily. Now, tech's going to get dragged down with it. You're never going to see the S&P drop 55% and not see the Nasdaq come down almost as much. So, all right. So those are the numbers. And again, put it in perspective. I do that because it's very, very important. If you're a trader, to know it's that where we are here, that map I always talk about when you go to Disney World or your big, one of the big mega shopping malls, and they give you the little arrow and it says you are here. There's that point in the mall you're at. So we need to know if, again, right or wrong, you have to, if you think you're in a bear markets are going to look like this, not straight down. They're going to zigzag. You got to figure out where in that cycle. Are you here? Are you here? That's the important thing to kind of know where you are. So anyway, all that was yesterday is a check mark. You guys know where I think we're at in this process. We just had a bounce that in a single day pretty much hit my kind of ideal target range. I was calling for 16% bounce, bear market rally. We pretty much hit that. I could see the potential for more, and it wouldn't surprise me in the least if that was it. And one day wonder, if you missed it, boom, it's over. So again, bear markets are like I always say, like bull markets. Well, I love trading them. You got to be nimble. You got to be precise and nimble, and you cannot stay too late to the party. Like for example, staying short too long into yesterday's lows. If you covered your shorts and waited to the end of the day, you got cooked. Likewise, if you waited to sell them, well, whatever, not that much now, 3% pullback. But I always say bear markets are just like bull markets, except you have that remote control on your couch or watching Netflix or whatever. It's like hitting fast forward with that 2x or 5x speed. When you hit fast forward, you get the 3x whatever, and that's what it's like. So it's much faster, but it's the same thing. You just look at everything in reverse. Look for the counter trend rallies, bullish falling wedges to support. So here's the Nasdaq. IWM, and this one I also bought this morning, just before this video. Nice support right here, 183.65. Again, this is a profit taken from yesterday, and so at minimum, I'm looking for another bounce up. Where to? I can see a little more upside on the Nasdaq. Let me see. The smallies. Here, I've got a RTY, trade futures, so this is a chart I have marked up. I just showed you support on IWM, the ETF, and you could probably do the same thing. Here's a downtrend line. I'll not only trade the futures with my primary trading accounts, but I also chart. I like charting them, and I encourage that even if you don't have a futures account, they have free futures charts from if you have a Schwab account on the Thinkorswim platform, investing.com, TradingView. Those are charting platforms that will give you free real-time futures quotes. And because the futures trade around the clock, you have different reactions you won't see in the ETFs. And so there's trend line 1. There's where we hit yesterday. Excellent time. Again, a lot of things to exit. The longs, it was about high to low, and the smallies, we rallied about 14% from the lows. Small caps are just more volatile than large caps. So they go down more and typically in a bear market, up more in a rally or a bull market. And so here's kind of, just near-term stuff. It should the market be able to rally today, which I suspect. I think you're going to see charged up some bulls and dip buyers yesterday. So come up here, pop that level. It's resistance, but we already checked it. We'll probably take it out and run up there. That's what I'm looking for. 1998 plus a downtrend line intersecting resistance. That will give me about a 7% gain on RTY. Or IWM, same thing. And then look, if we can build on that, if this rally gets some teeth, then there's the next downtrend line, a potential target. You can see my resistance levels. Just pause the video, screenshot it, and replicate it. Those are all the levels right there. What next? SPY, even if you're not trading it, you want to watch it. This is a 60-minute chart. You can see that was resistance right there. We had a brief shoot through it yesterday. And there's that right there, that candle right there, and there's a gap, big old monster gap right there. That's what the SPY ran up to backfill. I think the technical top of the gap, I just see a little candlestick shadow, but the opener close, the fat part of the candle is right there. So basically a test the bottom of the gap. There's another gap there. Support right there. Should we go a little lower, there's support. They'll probably step in and buy right about there. That's the breakout of the trading range. Yes, I remember you had the comparable trading range on SPY. So this is what it looks like in SPY. I think we'll get a worst case that, but most likely this. That's why, if I thought it was most likely this, I'd hold off or maybe just take a smaller position. But instead I increased on that pullback right after the video started. Come up there, you got resistance about 548, and then the downtrend line just above it. Big old gap right there. I'm going to pull this line down. Let's just put that line at the bottom of that gap right there, or the top of the gap right there, 561. Max bounce target. If this market gets a little giddy, we'll go back and maybe want to test the bottom of this multi-month trading range that we broke down from there and back tested below. So max bounce target. I'll just have to play it by ear. And right now I'm just looking, one step ahead instead of 3 or 4 steps ahead, because we're not going to go, unlikely we're just going to go straight there. Even if we get there, it'll be more like I just showed you, zigzag back forth. All right. Let's talk the other things. I increased this morning some of my ag commodities. Here's wheat. This is a 60-minute chart. I'm going to pull this line here a little bit just to tighten it up right nice and clean on these reactions, and I plan to even add a little more. Covered it the other day. I told you in the last week or so, last 2 weeks, I've done a couple updates that it's been kind of dead money, but I still like it longer term. And I've had a small position I've had in it. Been focused mostly on the stock market, but with that market volatility, I think you're going to see both institutions and some adept individuals start moving into commodities that just don't like have a bad taste in their mouth with the volatility in the stock market. But I would never buy commodities just for that theory or reason. I'll only, anything. I'll buy anything I need to make a case from technically. This is a nice, we've been just slaying these divergent lows for a year now. I've been highlighting these divergent lows. I'll give you we've had longer term targets, but then when we keep hitting T2, we keep getting negative divergence. We get these pullbacks, go back to another divergent low. I've covered wheat here. Let me get to the long-term chart for those new. By newbies, I'm just saying those new to the site, or even existing subscribers that may just be catching up now. This is my long-term chart of wheat, continuous contract. This is on stockcharts.com. You can see the year breaks down below. This goes back to the 90s, like 1999 right there. There's 2000. This is a very long-term primary uptrend line, which we fall into right here. I've been highlighting for years. You can go back on the site. These are all covered here. These bullish falling wedge breakouts. These were trade opportunities before. That was the last. So basically, we've had what I like to see are a big positive divergence on this. This is a weekly chart. So these divergences span years. You can see they usually take about a year or two to form. And that's what we have here. In fact, you can see I had a dotted line here. I haven't updated in a while. I have to go into annotation mode on this chart. It's a little more clunky. That's why I usually use the other charting platform. But that was just me projecting because we got close. There it is. That's pretty much a touch of the trend line there. That was a divergent low. Any new marginal new low will still be a divergent low. This is an end of day chart. They don't update it till the end of the day. But either way, you can see these are long-term targets. So then they're probably, I will add to WEAT additional targets if we start to get some traction. Wheat is what I call a trendy little sucker, a lot like coffee and orange juice. Some of the other commodities, cocoa, I've showed you before, coffee, which I'm currently short and have been for a while. I've shared that with you. Coffee tends to go parabolic, so does wheat, meaning it gets in these uptrends and it just rocks, and it just this is a parabolic advance. This is a linear downtrend line. This is a parabolic uptrend right there, increasing slope on the line. You guys remember what is that? Trigonometry? No, not trigonometry. Geometry, whatever, 101. Either way, there's the parabolic trend line. And this one, right now we haven't broken up, but we're at support. I like buying things that are oversold at support or with positive divergence. And I love selling things, especially when they've gone parabolic. You go short. And whatever, take it, don't take it. It's something, again, it's not screaming yet. It keeps putting in these divergent lows, keeps getting these little fits and starts, which is what you get when you start to bottom. You get these little nice rallies, and then one of them finally is the one that sticks. And then it has potential, wheat does, to explode. So let me go back to the chart of WEAT. All right, there, you can see it on the 60-minute chart. If we could pop that level. These are still the long-term targets from last year. We're really about where we were, so there's been no change in the long-term outlook. The divergences continue to build on that long-term weekly chart I just showed you. And then in the shorter-term world, the 60-minute chart, just look for these little 60-minute divergent lows, even if you just want to swing trade it, even if you don't agree that wheat has 100% plus upside from here in the next year or two, like I do, like I believe. Even if you just want to gain these little, quote-unquote, little 17-20% rallies, whatever they are. And then let me show you wheat futures. This is ZW, wheat futures. You have, as you can see, you had a downtrend line. Oops, that's not my line tool. This is my line tool. Yeah, nice clean downtrend line with positive, aka bullish divergence forming. You had a breakout back test, nice tradable trend. That trend ended right there. Trend line break, went down. And wash, rinse, repeat. Downtrend line, breakout, your back test, running up, target 1, target 2, and then almost likely add additional targets at that point if we start to get some traction here. So right now, it just needs to clear these recent highs. It should continue on up. Let's see, we have corn and soybeans are your kind of sister trades to it. Corn, I've been highlighting. Corn, like I said, and soybeans are still off their lows. Again, I started getting bullish on these guys last year, longer term. And corn has been in an uptrend. It's not a crazy uptrend. We hit my first target there. We hit it again here. And we need to go ahead now and take that out. I've covered this quite a bit, and then hit those other targets. Either way, you can buy it right now, right off trend line support. Buy pullbacks to this uptrend. In fact, I didn't have it marked, but now I do. That was that pullback most recently right here. A little slight brief undercut gave us a divergent low. I love me some divergent lows. So I'm going to, oops, I was going to borrow that DL, but I'll just write a new one here. DL, divergent low. So that should at least take us back up to T1. The fact that we keep hitting it, if we pop it, that's where these corn and wheat probably will start to scream. Soybeans needs to take out SOYB is the ETN for it. Needs to take out the downtrend line. Remember, we're coming off a divergent low. We still are above that low. Hit that downtrend line, pull back. We're back to this support level we've been trading on since about roughly. Had a couple brief dips below it, but that's it. So we pop that. T1's already been hit. Next target T2, 3, 4, 5, 6, and so forth and so on. And again, if nothing else, a simple way to diversify. Asset allocation. Diversification and asset allocation are utmost importance in investing and, in my opinion, in trading as well. Especially when right now I'm gonna, like I said, gonna pull back a little on my exposure, my position size to the equity markets till I get a little more clarity, and until it feels right to push it hard again. So at this point in time, just whether it's a long-term account or a trading account, this is asset allocation. Remember, diversification doesn't mean that you have QQQ and you have positions, 10 positions: Apple, Amazon, Microsoft, QQQ, and XLK. They're all the same. The tech ETF, QQQ. That's overlap. That's non-diversification. I don't care if you have 100 positions. If they're all tech, if they're all highly correlated with the stock market, they're not. Asset allocation means you have stocks, aka equities, bonds, aka fixed income, commodities, and there's within commodities, the commodity arena or asset class, you have many different types. You have the metals, both industrial and precious. You have agricultural commodities. So a lot of different things there. And then you can even have crypto as a different asset class. I gave you some trade ideas recently on Bitcoin and Ethereum. So those are, I count as really a new, kind of the latest asset class, if you will. So that's it. And then that's it. That's your portfolio. Now, what percentage you're going to have is up to you. The grains aren't screaming. They've been kind of dead money lately. But again, it's all, to me, everything's about risk reward. I think the downside is most likely limited at this point in time on a lot of those. So that's it. I wanted to cover that. Let's talk bonds real quick. Last week, I told you and shared a trade idea to short treasuries. Treasuries went down. They had been going up when the market was falling, and all of a sudden, as the market was making new lows, treasuries started to dump. A lot of headlines, a lot of out there are saying that this is why Donald Trump cowed down and put the 90-day pause on. There's been a lot of talk how in his first term, he benchmarked his success almost on a daily or even a minute-by-minute comparison with the stock market, saying, look how good I am, the stock market's going up. He's been absolutely mute on the stock market, but they've been talking about treasuries. And maybe the guy's a little more smart than he comes off. Maybe he does understand, because I surely do, a lot of smart people do, the importance of the bond market. If the treasury bonds, if yields get out of control, if the bond vigilantes continue to show up, and that's what they did recently. This is what we call the bond vigilantes. It's kind of just a metaphor for those, whether it was China retaliating, selling U.S. treasuries, or other countries, or even individuals here in the smart folks in the U.S., institutions, hedge funds. So either way, when yields drop, bond prices drop, yields go up, and we just can't afford it. If we continue and we go to where I ultimately think we go on treasuries, the U.S. will ultimately have to default on their bonds. They'll do a tactical, not an outright default where they don't pay you. They just print more money to pay off the existing bonds, kind of like a Ponzi scheme, if you will. And anyway, we'll watch. I want to say just watch this. I told you the other day, kind of standing aside. I covered the short. And I'm watching this, but this is important. So let's just talk longer term real quick. This is the 30-year bond, the yield on the 30-year. This markets aren't open yet, so this is through yesterday. Look at that spike right there. Again, normally in a stock market, especially one of the biggest drops we've had in many years, which we just had, and you start to see this. And so when this happened, while the market the other day, was at a 52-week low, that was again a red flag, and that's why many are saying that the timing of Trump's pause on the tariffs had to do with that. Whether it did or didn't, it should be something to really take note of. So now I'm going to go to the longest term. This is nothing new. This is what I've covered many times in the past. I've made the case that this is a secular downtrend line. This is when interest rates peaked in the late 80s. You have a primary downtrend line that was taken out. That was a confirmation that we're, in my opinion, in a new uptrend. Also, by every metric, downtrend is defined as any security making lower highs, right? That's the definition, and lower lows. So and this was a price channel. So by every metric, and then you see these big downs here. That's when the Fed, in all their infinite wisdom, decided they can quantitative easing worked back in the financial crisis. Say, let's just keep doing it, and zero interest rates worked. Then when COVID hit, they said, you know what? Let's just go crazy. We'll just print so much money, and there's no problem because inflation. We keep doing this quantitative easing. We keep printing money. The old economic books are wrong. You can print money all you want, and there is no inflation because the U.S. is just great. Whatever silliness. Obviously, I'm being very facetious, but then they, went crazy with the zero rates again, kept the pedal on the metal. Even when the stock market was roaring to new all-time highs, the economy was firing on all cylinders. Record low unemployment, record profits, and they just kept pushing it, kept the zero rate policy going, kept it going, and then, what's this? Oh, inflation. You remember they were dismissive of it. Oh, transitory, COVID. All of a sudden it's not transitory. So then they started raising rates. They saw the genie's out of the bottle. So the inflation genie. So there's where we're at now. So all this. And now there's a lot of talk of recession. Normally, if there's the odds, which they have gone up recently for recession, you'd see Treasury yields falling. And guys, they still very well made. This is big support here, about 39, about 40, which is a 4% yield on the 30 year. And we could do that and still go all the way down here and back test my trend line. That'd be a big drop in yields, and bonds would rally. And it would still keep my uptrend and my longer term outlook going. So I'm going to have to watch bonds very closely. Now, if that happens again, yields dropping, bond prices going up, it can be because of one of two things. It could be lower growth expectations in the economy, but it could also be if yields are going down, those lower growth expectations in the economy primarily, but you can also get a flight to safety bid. But now let's just watch this. See this line here, and I have it on the 10-year drawn out. I've had it for a while. This was a divergent high. There was a nice uptrend line there and a secondary uptrend line there, which broke, and that sent us down. But we've been holding this support, and what I think is the most likely scenario, and again, I'll just take it as it comes, and it will impact my outlook on the stock market as it develops. But I think we'll probably break out here this year. And again, as the bond vigilantes continue to protest, remember Trump. A lot of folks out there, are giving him high marks for how he negotiated, how he played his hand here. With, it was really about breaking China, not about the other countries. Seems like it was a smoke screen by blanket tariffs on everybody. And then he probably hint, whisper, picked up the phone, called the EU, called all our allies, said, hey, don't retaliate. I'm not going to do this to you. I'm going to back off. Well, I'm trying to get China. That seemed like the plan, and so far you got to give him points if that was pretty genius. Now, where I'm going with that is this we could see yields go up here, hit that, go on up, and then put in a divergent high at much higher levels. And if yields go up this year, that is nothing but bearish. What I was gonna say a minute ago, I got off point. Trump, although he is, like a lot of Republicans, pro-business, pro-growth, unlike Reagan, who was a fiscal conservative, he is not. Trump is a spender. He's every bit as much a spender as Biden. He just spends on different things. Biden wanted to spend on the big green plan, lithium batteries, get away from Trump's opposite, drill. But make no mistake about it, he will spend. He wants to reduce, cut taxes, which will add to the deficit. Obviously, Republicans tend to do that. They think it will spur economic growth, but in my opinion, a recession is just almost baked in the cake, and so that's actually backfires if you cut taxes. And the economy does go into recession. You have declining revenues, number one, just from the diminished economic activity. Tax receipts fall, even if you kept tax rates where they were. So you couple tax cuts with a recession, boy, you're going to really the deficit's going to explode. And then this would just kill the U.S. right here if we continue to, because we have to fund this. Yeah, the Treasury, and starting with Yellen, before Besson, we had Yellen. moving over and issuing on the short end of the yield curve, that's a temporary stopgap measure. You can't keep only issuing short-term debt, because then that starts to roll. Everything she was doing, instead of selling a lot of long bonds and locking in this for 30 years, that short-term debt's going to come due, and that has a risk of coming due at higher and higher rates, and then that adds to our federal deficit. You have to meet the interest expense, and that's been a ever-growing piece of the federal outlays recently. So we'll watch this. All it is, guys, right now is a big old trading range. I suspect it'll probably come up here, but that's it. We're range bound, kind of like what I told you the other day in the stock market. You have a level here, trading range. If we pop to the upside, if break to the upside, that's probably where we're going to go and it could last for a while before we reverse. If you go to the downside, that's going to be bearish. We could go as low as this. But remember, that could also be because we enter a pretty deep recession and Treasury yields plummet due to economic growth expectations. Just have to kind of, like I said, there's different components that cause bond prices to go up and down. It's not just the economy. Historically, for many, many years, it was, because there was no question about the U.S.'s ability to repay or the fact that we were the world's reserve currency. Now that has been increasingly coming into question. We know that China, Russia, the BRICS are trying to get away and create their own reserve currency. They're trying to get out from under the U.S. And now there's talk that even some of our allies might as well, due to Trump's kind of bully tactics and everything else. So, all right, I'm rambling on what is fundamental, kind of longer term stuff. I will continue to monitor the near term charts of Treasury bonds. This is TNX. I've had this line here. You can see since I created that back in 2024, back in May, kind of my, not an outright prediction, but yes, what I favored when the whole world thought rates were going to just fall from this point. When Fed started cutting rates, remember, the Fed lost control of the yield curve. They had 3 in a row rut row moments, 3 woofs, shooting at the basket and completely missing the hoop, and woofing, or whiffing, in baseball it's a whiff when you swing and miss. And so in other words, the Fed cut and rates went up. They cut again, rates went up again. They cut again, and long-term rates. Remember, the Fed cuts only short-term rates, but nobody borrows at what the Fed sets. That's overnight lending. Only banks do. Banks get to borrow at the federal funds rate. You and I can't. We have to borrow. You want a car loan or a mortgage, you're going to borrow at the market rates, which are set by treasuries. So then the Fed realized, oh no, we've now lost control of the yield curve. By cutting rates, usually long-term rates would follow what the Fed did, and they have not been able to bring rates down. And so that's it, guys. This is everything right now for the next years to come. If we get this, rates continue to move back up, right, the recent highs, which we're really not far from. This is the 10-year. This is the most important bond. This is where mortgages are benchmarked and everything else. Even 30-year mortgages track the 10-year closer. We are now at where rates were back in the late 90s. See that? You take a line across here, and that's it. And again, we're clearly taking out the trend line. We're clearly in an uptrend, series of higher highs, higher lows. That uptrend starts to get called in question a little bit if you start taking out previous reaction lows. Will get called into question more if you fell back down below the trend line, but I don't see that happening. And if it does, I'll assess it at the time. Why are rates falling? What's the stock market doing? Because again, rates can fall if we have that bear market I'm talking about. That's a very real possibility due to demand destruction, and future growth expectations. So either way, so in other words, it's not binary. This can be bullish for the stock market, or that may prove to be the stock market may be falling and that's bearish. This, however, guys, let me be clear. I see absolutely no way that is not anything but net negative for the economy and the stock market. So let me be very clear on that. This can go either way. So watch treasuries, watch those recent highs in yields. You'll hear about it. You'll hear about it on TV. You should if the 10-year and the 30-year start to break out of those recent highs. It means the U.S. is in trouble. All right, enough on that. That's kind of bigger macro stuff. Opening bell in 2 minutes. I'll sit tight. Let's see what happens. Like I said, This pre-market profit taking, even though the CPI, we're kind of going around sideways here. Look at that. There's QQQ with the pre-market. I'm going to put a line right here for you. This is support. Opening bell is going to ring. If they take it under, watch for a reversal. That would blow out. That would be nice to see this. Not the drop. I'm being long. I don't want to see that, but I would love to see it and then followed by a immediate recovery, because this would show you that short sellers would jump in there when that level breaks, and weak-handed longs will get stopped out. I'd rather be long when there's not a lot of weak-handed. Weak-handed longs are longs that are just looking to get out and sell in any minute. They're, I want strong-handed longs when I'm in a long trade. And so I want the weak-handed longs fleshed out. Now I'm talking micro stuff. This is a 1-minute chart, so this is not a big deal. I can go down here. I'll decide whether to add, sit tight, or stop out. I already showed you where I could see it going down. There's really, this is the next decent support right here, 443.15, which is exactly 2.28% below where we're at. And if they don't buy it up here, I would put good odds they're going to buy it up there. That'd be my guess, right? All right. Okay, opening bell in 10 seconds. So let's see what happens here, and then I'll wrap the video up, get it out to you. Like I said, grain's looking good. Coffee still looks good for that parabolic top. Oh, there we go. So we gap down, it turns off the pre-market trades, but there's that line I just gave you. And let's see where we go from here. I probably should wrap the video up. I can sit here and watch what the market does all day. Maybe it wants to kiss this line and that I have here, that previous reaction low. Yeah, I'll wrap the video up, because if we sit here and watch it trade, it turns into from a 40-minute video into an hour video. So you have my thoughts. You have the levels. What else? I don't know. If I come across any other trade, natural gas. Natural gas looks like a short. Remember, I threw it out as a long a week ago, but it didn't. It dropped below here on the trend line, and it just came back up and back tested right there, and that provides a nice short entry there with a stop somewhat above this 1970. That was old T7 level right there. And natural gas future right here. You take this uptrend line right here. That's the one we bought at recently. Remember, if you're new to the site, we were in at the lows, literally the lows of 2024, milked it to almost the exact penny. My long-term target that I maintained since last year, right here, was 490 was my target. It was hit in you won't see it on the regular charts. It was hit in the pre-market session right there, and this reflects that. And then we went down, we shorted it there, or at least I posted doing that. I'll post as objective short because the final target was hit. Got this nice drop. We gained one long bounce already, and then took another shot here, but then it broke, said stop out below the trend line. And this is just a back test or near back test of the trend. If it pushes up a little more, you can back test. So it's a short with a stop somewhat above the trend line right there. And probably target down here about 314. A lot of futures have rolled last day or two. Some of these ag futures, I might be on the older charts here. Nat gas, what do I have here? Still the maize. The maize still have plenty of volume right now. Okay, guys, I'm going to wrap it up here. Market's kind of just still floundering around. Nobody wants to step in first, so that's it. We're holding that support right there. You guys know my thoughts and where we go, and if we drop, where we're going to go to before we bounce, most likely. But I feel pretty confident of a bounce right here. And I might even add one more lot, go a little heavy just for the bounce, because I can see we're holding that support. So let me do that. I'll stop the video here. This has been Randy Finney with Right Side of the Chart. Have a great day.